Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday morning, August 17th, 2021, and I'm pre-recording this Trading Places Live just a couple hours early. Futures currently are down this morning. The Dow Jones Industrial Average futures are down, let's get you the latest, down about 225 points. S&P 500 futures down 23, NASDAQ futures down 62. Been seeing some weakness overnight for sure. Yesterday got off to a rough start. We saw some buying. We'll see whether or not that happens. We got retail sales report coming out in just a bit. And we're going to go through all of that in just a couple minutes. Let me first walk you through today's agenda. We're going to go into the daily market recap, talk a little bit about what happened on Monday. Then talking technically, plan to look at a few industry groups that have been weak on a relative basis for the last month or so. So we'll go through those. Going to break down the retail group a little bit and break it down. New segment, Bullish Trifecta. This is actually a chart list that I put together. I want to go through, talk to you a little bit about the rationale there and how I put this list together. Then we'll get into earnings spotlight. We'll wrap up with the three you must see. But first, before we get into that, let me take you over to Earnings Beats. Just want to let everyone know that if you go over to earningsbeats.com, you can sign up for a no-cost trial. We'd love to have you as a member at Earnings Beats. Got some big stuff coming up this week. Later today, 4:30 Eastern, we'll be having our August Max Pain webinar every month. The Tuesday before options expire, we take a look to see what stocks are shaping up to potentially run into problems heading into options expiration week. And then there are other stocks that have been getting hit pretty hard that may actually see a bounce because of options expiration. So if that's of interest to you, probably really enjoy that. That is a members only webinar today at 4:30. So again, it's a free no cost trial. So you can start that right there at our homepage. Or if you'd like, you can scroll down. We have a free newsletter, the Earnings Beats Digest. Just simply type in your name, email address there, and we'll make sure we get that out to you. It's published 3 times a week, Mondays, Wednesdays, and Fridays. That is completely free. There's no credit card required. You can unsubscribe at any time. Very educational in nature, but also plenty of trading opportunities if that's your style. All right, let's move on and talk first about the daily market recap from Monday. Rough start to the day. You'll see all the major indices well off of their lows from earlier in the session. The Dow Jones Industrial Average was down quite a bit earlier in the day, managed to finish up 110 points. The S&P 500 also down early, came back, finished up 12 points. Both of those indices rallied to finish at all-time highs. The NASDAQ had a nice rally back up above its 20-day moving average. No new all-time high set, and it did finish in negative territory, still down 29 points, but it was down a lot further earlier in the day. So definitely a nice rally after the first 30 to 60 minutes of selling. Mid caps also bouncing off their 20-day, finished down 6 points, or about 0.25%, but still well off the lows. Same goes with small caps, down about 0.5%, but well off the lows. Healthcare, and it was another similar type day in sectors. We had the defensive groups leading as we did on Friday. On Monday, healthcare leading, gaining more than 1%. Utilities up about 0.6%. Staples nearly 0.6%. All three of these groups you can see breaking out here to new highs. Technology actually broke out to a new high, but we still have that negative divergence in play, which is a little bit worrisome. But technology continuing to look strong as far as price action goes, moving to a new all-time high. And then on the flip side, energy, once again laggard. We've been struggling to get back through that 20-day EMA, and yesterday we gapped down from there, went back down, hit 48, which was a reaction low that we saw toward the end of July. If we lose 48, I fully expect we'll go back down and test this 46 area, which was the low back in April. And then also we got close to 46 back in mid-July. The good news for energy, if we do get back to that 46 level, chances are we're going to have a pretty strong positive divergence in play. So I do expect $46 to hold. All right, moving on to the 10-year Treasury yield. First, got a lot of economic reports out this morning. None of them out, but as I'm doing this recording, but by the time you hear it, a number of these may be out. July retail sales, I know, will be out at 8:30 this morning, so that'll be coming up shortly. But the expectation there is for a drop in retail sales, a drop of about 0.2%. June, we saw retail sales jump by 0.6%. So looking for a little bit of reversal there. If we strip out the autos, July retail sales are expected to jump 0.2%, but June soared 1.3%. So we're definitely looking for things to cool off a little bit here in July. The July industrial production numbers will be out later this morning. That the expectation there is for a rise of 0.5%. June rose 0.4%. And then capacity utilization, which was 75.4% in June, expected to jump up 75.7% for July. June business inventories expected to rise 0.8%. May rose 0.5%. So things are picking up there in terms of inventories. And then the August housing market index, back in July, it was 80. We are looking for 80 once again. So a lot of economic reports out today, but that big one will be retail sales. We'll have to see how the market reacts and whether or not we see any good news there. I'm going to take a look at the XRT, which is a widely diversified retailer or retail ETF. I'll take a look at that in just a bit. You can see on the 10-year Treasury yield, we had that positive divergence. So we saw the yield go down, close at a lower level with a slightly higher PPO. We went back up, broke through 130, which I thought was a good sign, but it seems like at this point, all we did was went up to that 50 period moving average, in this case, 50-day moving average. The PPO got back close to the center line, and now we're starting to roll back over again. We really want to see this move up. And I think the retail sales report, when we get it, will have a big impact here. So if retail sales come in stronger than expected, I would expect to see the 10-year Treasury yield jump. But if they come in weaker than expected, we could be heading back down to maybe for a triple bottom down there around the 112, 115 area. So those are a couple of the scenarios maybe to watch for later today. All right, let's move on to talking technically. So what I wanted to do here is just go over some of the worst performing industry groups just to see if there's hope for any of these groups in the near term and what to look for. So the first one, Brewers Index, definitely downtrending. This has been the worst performing group over the last 30 days. And I think it's pretty clear why. I mean, the index dropped from the second week of June near 950, and now we're down at 668. So we've lost, 30%, more than 30% of the index value. And that's just over the course of a couple months. So definitely the group is in bad shape. If there's one silver lining here, maybe two, it's that volume on the selling that we've seen the last few days. You can see the volume is tailing off. Perhaps selling is exhausted. And the other thing that makes me think maybe we're getting close to a bottom is if we do break to a new low in price, for the first time in this downtrend, we're going to see a positive divergence, a pretty good one. So you've got gap support over here at roughly 665 or so, maybe just below that level. And then you've got previous lows that come in, the September, October lows just below 625. So I think as we move to this, if we do move to a new low, we're going to run into some areas of support and at the same time with a positive divergence. So things don't look as bad as they have for the past couple of months, but still clearly in the downtrend, looking for a reversal. Next up, take a look at the Broadline Retail Group. Of course, we are getting retail sales out. We'll find out a little bit if we're going to make a big reversal. But yesterday, we did see the group down significantly early in the day and then rally back. That type of a move to the downside with a long tail like that many times can signal a bottom. If you look back at the March low after selling off for a little over a month, maybe 5 weeks or so, we had almost an identical candle that led to the rally beyond that. So I actually like this candle, and I'd just like to see a new high set today after retail sales come out. So if we can follow this up with another move to the upside, the worst could be behind this group. All right, next group up is delivery services. And we're trying to get back through the 20-day. This is going to be a difficult test here because not only is it the 20-day, but if I annotate this for you, you'll see broken price support now becomes resistance. So here was your support, moved up, came down, set a low, went back up, came back down, and on big volume lost that prior low. So that now establishes resistance. Until I see a break on a close back above, say 1635, 1640, till we get that close, I think the path of least resistance here is to the downside. So I'd be careful with delivery services here in the near term. Another weak group, media agencies. We had gapped down. We got some pretty good support coming in here between 700 and 725. So once again, annotate this for you. The recent lows, you can see the candle bodies right here back at the beginning of the year. And then again in mid-May, right at about 715, 720. So I would definitely be watching that level. And then maybe this breakout right here, where we went up, broke out, went back a couple of different times, tested this low. A couple of these intraday lows have gotten close. So I'm just going to say this range right around 700 to 720. Pretty good area of support. I would also continue to watch to the upside. Key resistance up near 875. So we're coming off of an uptrend and trending sideways. I'm going to give this a pretty good chance of holding before we break below that 700 level. I would expect we'll see a reversal and move back to the upside. Remember, we are also part of a secular bull market, so we should be looking for reversals back to the upside. All right, how about toys? Toys, another weak group. Now, this group did just barely break down. We are seeing divergences starting to turn up a little bit. The one positive here, I would say, is just that the AD line has held up pretty well. So there was the prior high. We broke out above that, went up and set new highs. So good news there. Then we came back down, and then we established these lows. So we had these other lows in here. So I'm going to say that was pretty good support. We just went a tad below it. You know, this is an area where I really would like to see the toys turn. And I mentioned the AD line. You can see the AD line is still holding from prior lows, and we're not that far off the highs from back in April that we saw. So I don't know. It seems like, yeah, we're weak, but seems to be some institutions maybe out there willing to accumulate on this decline. So again, this is a group that I would watch, maybe that 1275 area right in here. Don't know that I want to see a low go below these prior lows. If we can hold there, maybe we're set for a nice little reversal. All right, how about the mining stocks? I am not a fan. I've been on record for a long time saying I just don't trust the group. I think the dollar goes higher. And if the dollar goes higher, that's going to present headwinds for the gold mining group. And so when you get the short-term breakouts, you certainly can trade it, but you want to be careful when you break back down. And so that's would be my warning for this group. We do have positive divergence. You can see these lows on the PPO getting higher while price lows are getting lower. That's the good news. The bad news is, though, I don't really see any key support levels. If all this was happening and we had reached this support level, I'd feel a little bit better. I don't know. I think you've got a little bit of room potentially because of those positive divergences. Maybe we could get back up to the 140 level, but I'm still really nervous. This is one of the groups I'm just not very keen on because, again, I am expecting the dollar to strengthen. If the dollar strengthens, gold will struggle. If the market does weaken here in the near term, usually that higher volatility, the VIX, normally plays into the hands of the bulls here on gold. So maybe we will get that short-term move to the upside. I just think intermediate to long-term, I'd be very careful with this group. Short-term, could be a volatile period. Let's just look at one more, and this is in the financial area. This is consumer finance. So consumer finance made the list. I think it was like the 10th or 11th worst group, but I like this group. This is a group that's been going higher. You can see the PPOs worked its way back to the center line, which for the most part is held throughout much of 2021. Got some really good support. We've bounced off this 510 area 3 or 4 times now. So I would be using 510 as really good support. And we got down yesterday to a low of 511. So this is an area I would look, it's in an uptrend. I suspect we're going to see some additional strength. I also like the fact that we're almost ready to break out on the AD line, even though we've been struggling for the past 2 to 3 weeks. So overall, I think this is a pretty good candidate for a reversal. All right, let's move on to break it down, talk a little bit about the retail group. So we do have July retail sales coming out this morning. By the time you hear this, it will have already been out, released. We'll want to take a look. The expectation is for a drop of 0.2%. The estimates are all over the place. I think I saw anywhere from a drop of 0.6% to a rise of 0.2%, with the consensus being right there in the middle at a minus 0.2%. But as I look at this chart, we had the huge run up after the vaccine news came out, that positive vaccine news back on November 9th, gapped up, pulled back at the 20-day, and then off to the races we went. I mean, we were at the 20-day down around 53, 54, and less than 3 months later, we had hit almost 100. So that was a huge move in retail, anticipating the upcoming strength. Now, retail stocks, after making that huge move, have been consolidating and letting the fundamentals kind of catch up with the price action. And so that's why I think the report this morning is pretty big, because if we can get a bigger than expected number, if we can get that breakout in the group, clearing all of these tops around 98, 99, up near 100, certainly an XRT close over 100 would be a very bullish sign. We do continue to put in these higher lows and then mostly equal highs coming across here. So it is a bullish pattern off of an uptrend. But I'd want to see 90 hold to the downside. If we do, have a weak report, or if we do get a weak reaction, watch 90. I think that's going to be a pretty important level. And then ultimately, 99, 100 to the upside. Now, as far as some of the groups go to watch, I would be looking at the clothing and accessories group. This is a group that just recently broke out. It's got a very nice PPO. So if retail sales come in weak and we do break back down to that 20-day, this would be an area maybe to take a look for. And I'll show you in just a moment how we would look for potential stocks in the clothing and accessories area. Another one would be home improvements. So home improvements, you can see the high that was forged back here in early May came with a nasty negative divergence. And of course, we went down for a while, reset the PPO, and now we're starting to rally back. And you can see we've been trying to hold on to this rising 20-day EMA, which is above the 50. PPO's in positive territory. So this is another one. If retail sales weak, home improvements sell off, let's watch that 20-day and see if we can hold it again. Then we've got apparel retailers. I think this is a really nice bullish cup. And the handles going in 20-day, I think would be a great opportunity to take a look at this group as well. And as we've been pulling back, notice the AD line trying to break out. So I think that even in this pullback, we're seeing accumulation. And yesterday, that long tail, kind of a poster child for what accumulation looks like, because a lot of selling early in the day, but then we saw the buying coming in later in the day, which is a signal of potential accumulation. Already showed you the broadline retail group, but let's take a look at specialty retail. And specialty retailers, you see, got up to about 27.50 here, 27.60 or so here, bounced off of the 20-day yesterday on the early selling, came back up, closed at a new high. And this is an all-time high on the specialty retail group, I believe. Let me just go back and make sure. Yeah, that is a new high, closing yesterday at 27.68. There is a negative divergence, though. So if we fail to hold the 20-day, we want to be careful, might get that 50-day test. If we did, if this market reverses and we got a 50-day test on specialty retail, I would definitely be looking at this group. I think we got a nice uptrend in play. And if we do, if the momentum issues do provide us a problem as we go forward, I think it'll be an opportunity, actually. Now, if the retail sales number is good and we break out again, I think it's very possible this PPO takes off and eventually eliminates the negative divergence. So that's something else maybe to keep an eye on as well. All right, I'm going to go into breaking it down, but I want to go into bullish trifecta first, because I'm going to use a chart list that I developed there to look for stocks within the groups I just mentioned and break it down. So let's move on to Bullish Trifecta. I'm going to go back to the dashboard, and I want to just show you, once we do our homework at Earnings Beats and we create the chart lists where we store all of our work, you can come down to the scans, and what we can do is we can do a new scan. Now, I've already got filters in my chart list, so I don't need volume filters. They're already in there. But what I can do here is I can run a scan to look for all stocks that are in our strong earnings chart list and in our strong AD chart list, which was just updated over the weekend along with strong earnings, and raised guidance. So let me just explain a little bit about what these are. So the strong earnings chart list is a chart list with over 600 companies that just recently, in their most recent quarter, beat Wall Street estimates as to both revenues and earnings per share. The strong AD list is a list compiled by going through all 11 sectors, finding companies within those sectors that have scooter scores or StockCharts technical rank above 80. So we want to make sure there's a certain element of relative strength, and also visually look good from an AD line perspective. So I'm just looking at the accumulation distribution line, like I was just showing you some stocks with that AD line at or near highs. That's what I'm looking for. I want strong AD. So we know we got strong earnings, strong revenue, strong earnings. We know now we've got a strong AD, and then raised guidance is a list of companies that have raised guidance with their earnings. So they're now lifting expectations going forward. So what I'm doing here is I'm running a scan that incorporates any stock that's on all three of these lists: beat earnings, beat revenue estimates, strong AD, and they raised guidance. I mean, that truly is like a bullish trifecta, fundamentally and technically. And so I run this scan, and I come back with 71 results. Now, I can then drop this into a new chart list, or I can replace an existing chart list, which is what I'm going to do. And I'm just going to go down here to scan results, other, and I'm just going to drop it in there. So now what I have is a chart list in summary form of all of those stocks that that scan that I just talked about. 71 stocks are in here. If I go to columns, I can now add my industry group. And what I can do is I can sort by industry group. Actually, I'm going to sort by sector and then by industry group. Or actually, no, let's do that the other way. Let's sort by industry group and then sort by sector. Let's do it that way. And so here's a broadline retailer that's on the list, Macy's. So what I would do is maybe just come down the discretionary area, clothing and accessories, Under Armour. These are definitely stocks in the areas I just talked about that I'd be looking for. RH in the home improvement retailers. Specialty retailers, talked about if we get that breakout or if we pull back to that 50-day, Dick's and Five Below. So this is a way that you can first take a look to see what maybe is an area that you're interested in, and then turn around and use a chart list like this to come up with some of the best candidates and look for stocks within those areas that you're interested in. So if we pulled up, I'm going to pull up Under Armour, because I think Under Armour looks pretty interesting here. Under Armour got up to this 26 area, fell back almost about to the breakout level, and then came all the way back up. Look at the volume coming in. Now it's going into a handle. So we got a nice little cup handle. Watch that 20-day to the downside or potentially a breakout above 26. Under Armour looks strong. All right, let's move on to earnings spotlight. So just going to go over a couple of areas here, or a couple of stocks. So first, Home Depot. Home Depot comes out with a really good report in terms of revenue and earnings, both beating Wall Street estimates. But the reaction this morning, stock was down. Last time I looked, was down 3% or so. But it's still okay. I would say down 3% is going to take us down about $10, which would be $3.25. That's going to be below the 20-day. So it could be that some of these home improvement retailers do go back to that 50-day. I think I was talking about that one earlier, potentially moving to the 50-day. If we fail to hold that 20 and move back down, that could lead the entire group down. So we do want to be careful there. Walmart came out with a very nice report, but we are up against resistance from back in December. Honestly, this looks a little bit like what we were seeing with Amazon. Long period of consolidation, although Amazon broke out before its earnings and then went back into the consolidation phase after its earnings. Well, we got Walmart, which is down 1%, 1.25% last time I looked this morning. Even though they did beat revenue, or the volume's been strong, we've had a nice move. I would watch that rising 20-day. I would think Walmart would hold on a rising 20-day test. So keep an eye out there. One company that is not going to fare well today, at least at the open, is Roblox Corp, RBLX. They reported yesterday after the bell. The stock reported earnings of loss of 25 cents. The market was expecting profit of 27 cents. Stock's down 5.5% today. And if you look back here versus its broadcasting and entertaining peers, it was at a high back here, but for the last 2.5 months, it's been going down. So it has not been performing as well. You can see the group has been going up and the stock has been going down, leading to relative weakness. Being down 5% today, that's going to be roughly $4. So we're going to be looking somewhere down at about 75-ish on the open, which looks like if it opens below 75.85, I believe that's a signal it's going lower. If it opens above 75.85, you'll have a better chance of the stock holding on to support. So that's what I would watch for there. All right, let's move on to the three you must see to wrap up. First stock I want to show you, and I want to talk a little bit about earnings and these earnings gaps, because I get questions all the time. These companies that jump up big with earnings, are they going to fill all the way back? HCA Healthcare is one, gapped up and kept going higher on its heaviest volume of the year. That tells me market makers could not get control of the action at the opening bell. There's too much demand for the stock. So normally what I expect is for a stock to return to the top of gap support, not the bottom. And you can see the stock actually went just below the top of gap support, printed a nice hollow candle, and now it's starting to resume its move to the upside. That's what I would be looking for on a stock like this. Next up, I want to show you the opposite. Now here's Yelp. So Yelp gaps up hugely from 37 to 43, but then sells off. Here, market makers shorted at the open and they were making a fortune. They had complete control of the action. Notice also the stock did not gap up above the prior high. So that was a clue it wasn't going to go higher. Comes all the way back down, and look at what we've done. We've filled that gap to the downside. And then the last one I have is On, and this is an interesting stock because it gapped up, continued moving higher, good volume, and now it's pulled back. But in this pullback to price support, gap support, the AD line's broken out. So I think the stock's being accumulated. I think the stock looks really good here. All right, that's it for me. Everybody have a great Tuesday. Let's see what happens after that retail sales report. And then I'll be back on Wednesday over at earningsbeats.com for your next Trading Places Live. That'll start at 9 a.m. Again, go over to earningsbeats.com and you'll be able to come into the show straight from our website. Everybody have a great day. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.